Old Mutual has been using the current market environment to rebalance some of its offshore portfolios. The investment firm has decided to begin shifting capital away from growth managers in the equity market and deploying this with value-oriented investors. Joining us from Cape Town to discuss these moves and the asset allocation strategy of the funds is portfolio manager Ovesh Desai. Just starting with the fact that you are overweight emerging market global equities right now. Can you take us through the rationale for that stance in the portfolios?
Yes, sure. I think to give you a bit of context first on how our investment philosophy works, I think that's important and will lead to our asset allocation views. We have a two-dimensional view of the investment world. One dimension is price, and that means valuation. Is any investment cheap or expensive relative to its history and relative to other asset classes? And then the other dimension, which is actually the most important and our true edge, is the theme dimension. And what we mean by theme is actually, is that asset class, is that investment in an improving environment, or is that environment for that asset class or investment deteriorating? That's where we mean good theme or bad theme. And where we want to be is we want to be overweight those asset classes that are cheap relative to other asset classes and that have improving environments, so positive theme. With that in mind, our favorite asset class at the moment is actually global equities. And the thinking there is from the first dimension, price or valuation, relative to the last 25 years, the forward price to earnings ratio on global equity is about 13.5, which is lower than its 25-year average and just above its 1 year, one standard deviation below that. Now, if you compare that to South African equities, for instance, we have South African equities at pretty much a similar price to earnings ratio, about 13.5, but relative to its history, that's already above its 25-year average for price to earnings. If you look at other global asset classes that we are invested in, within the fixed interest space, we're underweight global developed market bonds because we think those are expensive and are quite, the yields we're getting on these asset classes are quite low. But we do value some diversification in our portfolios from getting some global fixed interest investments. And for that, we're exposed to emerging market local currency debt. So that's giving us a yield pickup over developed market bonds, as well as some diversification. And we also have a bit of credit exposure. So that's your corporate bonds issued by companies, etc.
Ovesh, obviously the global equity market's a big one, and you mentioned there's a dichotomy between the developed market equities and the emerging market equities. I wanted to just get some insight as to really where you're finding value. And as I understand it, you're selecting the managers that operate in those baskets. Is that right?
Yes, that's exactly correct. So the way we manage our global building blocks is essentially we run the top-down asset allocation or strategy overlay from here in Cape Town, and the underlying building blocks of that are managed by our sister companies, all mostly part of the Old Mutual group based in the US and the UK. So for instance, our emerging market exposure is managed by Acadian, which is a subsidiary of the Old Mutual group. And our exposure there has been about just over 20% compared to a benchmark weight within the All Country World Index of about 11%. The thinking there behind that overweight to emerging market relative to developed markets is that if you look at the last 5 years, half of the growth in GDP in the world has come from China. The emerging market universe is exposed to much better, their economy has much better fundamentals than the developed markets. Their debt situations are improving and aren't as stretched as developed markets. Now, what that means is that they are less likely to be raising taxes or constraining their economies. You're also looking at within the developed markets, you've got valuations which are now, especially if you look at the US, starting to look a bit toppish relative to emerging markets where you are still finding value. So if you look at emerging market price to earnings ratios, these are trading at a discount to developed markets.
I'm interested in the one position which is overweight Japanese equities, having recently just discussed with George Glinos the fact that he sees an overhang of risk for the globe resting firmly with Japan in terms of the fact that we could see a potential implosion of that territory where what they are trying right now doesn't work. That's obviously not your view.
I think, so if we look at Japan, that's actually an interesting example where Japan has actually followed suit in terms of the US QE quantitative easing model, where Japan is now starting to pump liquidity into the economy, which is aiming to create inflation in the Japanese economy. But also what the kind of more immediate result is the weakening of the Japanese yen. Now, the Japanese yen has been incredibly strong for a long period of time, which has strangled the Japanese economy, especially their exporter market. For instance, if you look at just the TV segment, the TV I have at home is a Samsung TV, and you'd be hard pushed to find many individuals out there who have Sony as opposed to Samsung. Now, with the Japanese yen weakening so significantly, and in fact that weakening has been, if you look at the real Japanese yen trade weighted across a basket of currencies, it's at a multi-decade low. What that is doing is it's actually stimulatory to those exporters and to the export-driven economy of Japan. So that's why when you saw the Japanese yen weaken, Japanese equity stocks did very well, and the Korean stocks did significantly less well because they're obviously competing for that same export share. Now, within that, there is potentially the risk that you have a problem with Japanese government finance and the fact that they're monetizing their debt. Within our fixed interest portfolios, we've been underweight their debt and underweight the currency, but we have been overweight the equity because we think those equities are going to benefit from that weakening yen, which needed to weaken, and it's also going to benefit from an environment of global growth that is improving, albeit slowly.
Avesh, just to come back to that, is it just to be clear? Are you saying that what the Japanese government are doing at the moment will lead them out of this mess that they've been in for the last, I think, 20 years, or is it just a case of you taking advantage of the current situation because the Central Bank of Japan has indicated they will print for as long as it takes to get them the inflation that they're looking for?
I think it's a combination of factors. So if you look at valuation, like I said, the yen and the numerous issues which has been priced into that market. If you look at the Japanese price to book, that traded over the last year close to 1x price to book. Now what you're seeing is that those issues are being unwound. So the yen is part of that, the weakening of the yen. There are still structural problems that face the Japanese economy. For a long while, the Japanese companies have a history of not catering or not generating returns for their equity shareholders. They instead have cross holdings of shares and maintain employment where perhaps they shouldn't be. And you are starting to see tentative signs of that structural shift happening. For instance, Sony is now looking at listing its entertainment division separately, which should be an unlock of value. So there's tentative signs that there's more of a focus on shareholder value and returns to shareholder, and that's been a long-term structural problem. With the very low valuation levels, a weakening yen, and possibly structural improvements, which Prime Minister Abe has spoken about this morning, you're seeing steps in the right direction. I think it's possibly still too early to call whether that's going to be a trend for the next 5 to 10 years and whether Japanese equity will re-rate to its heydays of the late 80s, early 90s. But at the moment, we remain overweight Japan.
Just another interesting trend, and I think you called it a theme, but you indicated off air to me that you are also changing the composition of the managers that you use in your equity portfolio. You're shifting away from the growth managers, which have served you very well over the last 5 years, and putting more money, allocating more capital to the value managers. Just take us through the thinking behind that.
Sure. So essentially over the last 5 years, what we've had is we've had an environment where growth has been fairly low and fairly scarce. And in that environment, that growth, where you can find it, is going to be valuable. It's also been an environment that's very uncertain in terms of the economic growth outlook. And in that environment, the companies that have done well are the quality growth companies where you have a stable dividend, stable earnings, and predictable outlooks for these countries. We have been invested in a manager, or we've been overweight our quality growth manager in that space. But what we've seen more recently is as global growth comes through more slowly and more predictably, and that's increasing, we're now moving our allocations into our value managers. For instance, our global value manager is Barrow Hanley, another member of the Old Mutual Group based in Dallas, Texas, and we've been increasing their allocation within our global equity portfolio steadily. The thinking being that as we see a move to better global growth and away from this environment where investors are looking to preserve capital and get return off that capital at all costs, they may now start moving into an environment where they can take on a bit of extra risk, going into equities that are providing higher dividend yields and not just quality, stable dividend yield, and investing in those companies at all costs. So it's been a gradual shift. It's by no means something that we're doing radically, but we're expecting, and we're now a third of our portfolio is weighted in value stocks, and we've downweighted that quality growth exposure.
Vish, I just want to chat about the situation in the US. We don't have much time left in the interview, but the market at the moment is focusing on negative data points to rally, because that means that the taps will remain open. We'll see quantitative easing remaining the mainstay of the day in that territory. The minute that we see Fed Chairman Ben Bernanke hinting at removing that quantitative easing, then everything comes crashing down, and that's when you see the positive data points. Then obviously the US is gaining some traction. How do you see the US panning out from here? Because obviously the market is playing this one very interestingly at the moment.
Yes, indeed. So at the moment, what you're seeing is significant investor concern about exactly those worries about quantitative easing being reduced within the US. And this is understandable. I think to an extent, the market reaction has been slightly overdone. What we are likely to see, and what is being discussed, is a tapering of quantitative easing within the US. But if you look at global, the balance sheets of central banks, if you look at the US, the European Union, Japan, as we've spoken about, they're increasing their balance sheet at an unprecedented scale relative to their GDP. You're also now looking at a likely increase from the UK, from the Bank of England, increasing their balance sheet size. Even under fairly worst case scenarios, you're still seeing global central bank balance sheets increasing. So monetary policy is still relatively accommodative, and you still have that liquidity surplus. The US economy is improving. So it is normal for them to be looking at tapering their quantitative easing or increasing their balance sheet at a lower rate. They are going to be very cognizant of any impact of that has on the markets and the feedback into the economy. The impact on US government bond yields, we think markets could tolerate up to about 3% or above. If there's a drastic move above that, then you're starting to get into territory where you're looking at the economy being impacted. That's unlikely to be the case. We're looking at an environment where the US needs very low yields to finance their debt. Their expenditure is based on looking at their spending, but also how much they need to finance their debt. If the amount they need to finance their debt goes up, then they have to constrain their expenditure even further, and that austerity is not very popular at the moment. So they're going to be keeping yields at very low levels.